Hello and welcome to the DIY Investing YouTube channel. We are working through every company in the S&P 500 and today is Broadridge Financial Solutions, ticker BR. Over the next few minutes, I'll discuss both my thoughts on the valuation of this company and its business quality. First up, it is in the IT services industry. This has a market cap of $16 billion, EV of $20 billion. So we know that there's some debt on this business. They provide investor communications and technology-driven solutions for the financial services industry. So it looks like they're investor communications, distribute proxy materials for equities, mutual funds, regulatory reports, various things along those lines. It has a global technology and operations segments, including productivity tools, data aggregation, various different IT services, clearly, but targeting investor communications, financial services industry. So that's a little bit of information. The return on invested capital. So if we ignore 2006, we can see that every year since which looks like maybe it was a founding year, every year since 2007 has been a profitable year. That's a very good sign. And not only that, but they've generally been double-digit return on invested capital. I really like to see that. 2012, you had a 9% return on invested capital, but really the average is in this 14-15% range. You have some 18%, some 20%. Most recent year in 2021 was 11%. But overall, very strong returns here in that 10 to 20% range. This is what I like to see in terms of return on invested capital. Every year is profitable. Every year is in the double digits. That looks really good, especially when you put debt on the business. You can see that the return on equity gets boosted to a number like 31%, which is very, very strong. Now, the 10-year CAGR, we see revenue growing at 8.7%, assets growing at 15.6%, free cash flow at 12, EPS at 13. So what I get away from this is that I don't like that revenue is growing slower than assets. That means that over time you're going to end up with lower and lower returns, which is why you see this lower return here in 2021 versus the previous 2011. It's descended some across the decade because you've been growing your assets faster than revenue. However, your EPS is still growing at a double-digit range, so that's really good to see. Now, besides that, though, there are some concerns. You do have relatively low gross profit margins. 28% is pretty low, which limits your operating leverage because you can't really push much higher if you're not getting into that 50% range for gross profit. I really like to see that when I'm just seeing a high quality business, but clearly they're growing and that growth has been valuable to the business because of this high return on equity. However, the PE of 30 is concerning because that's quite high. To have a PE of 30, you really need a high growth rate. You need a high return on equity. They do have their high return on equity, but you're talking double-digit revenue growth, 15% plus EPS growth, and you need to sustain that for a long period of time to justify a PE of 30. So really something, at least below 20 for a business like this. But with these gross profit margins, I'd really want something under 15. You have strong, reliable return on invested capital. This company is making money every year, and that's been very good to see. But you see that this really, especially without this growth in 2017, your growth overall isn't very high. And so that's a little bit concerning just for your long-term performance. Because even though you have this high return on equity, you're going to be limited based on your revenue growth rate. And so that's really where you're going to see the returns because the return on equity is no longer a limiting factor. If you're enjoying this video so far, please hit that like button and don't forget to subscribe so that you can get more great videos that I upload each and every week as I finish through this S&P 500 series. You need to be subscribed in order to get those videos. So let's dive on into the income statement and see what else we can see here. So again, gross profit, profitable every year, going up every year, which is a really good sign. You can see every sequential year is going up. That's always a really positive thing to see. Similar to net income, you can see that every single year gets better than the last year. I guess look, besides 2019 to 2020, you did have some pandemic effects, so that could be a player factor here. I also like to see that shares outstanding is going down. Now, not a lot, but they are clearly buying back some shares over time, which has been adding to that performance. Let's look at the balance sheet. You see some pretty steady growth in goodwill. So they are making probably some small acquisitions over time in order to grow this goodwill with a big jump here in 2021 over 2020. especially that growth in intangible assets. So those acquisitions are playing a little bit into that asset growth. So it's possible that we'll see a bigger improvement in earnings later and revenue later because they made a recent acquisition that could be distorting some of those numbers we saw here for that difference. Something to pay attention to if you're an investor in the company or if you're looking at it. Now, they've definitely 10x'd or more their long-term debt. They basically had negligible long-term debt at the beginning of the decade, and now they're at $3.8 billion. So they're adding some leverage to the business. They don't really need leverage on this business because you see these return on invested capital is already at 16%, but it looks like maybe they're taking advantage of low interest rates, especially for making the acquisition that they clearly made around this time. So we can probably see that if we go to cash flow statement, it's probably going to be, yes, acquisitions. You can see there's almost always some small amount of acquisitions. It'd be interesting to know what sort of strategy they're executing here. Are these roll-ups? Are these kind of just adding new features to their business? Should we think of these acquisition costs as basically R&D? And you need to do a little bit of a deeper study, but you can see that big acquisition right there in 2021 is playing a big factor in the numbers we're seeing across the decade because it's all weighted at the very end. And that's where that big net issuance of debt comes from as well. You see stock-based compensation, pretty standard across the whole time. They're buying back shares each and every year, but it's not a lot, and it's not necessarily substantially more than stock-based comp, which is why it's not coming down to a big degree. You also are paying some dividends, but you definitely have a gap. There's some reinvestment needs here that are certainly present because you're buying back shares and dividends are about 50-50, maybe a little bit different. So it's interesting. I think this company would go on a watch list. I like what I see. Whenever I see a company with no years of losses for my study period, that's really attractive. I think the valuation's too high. I'd really like to buy this below a PE of 15. That's kind of like my bright line. And there's nothing in here that says I should go above that to a 20%, PE of 20 or higher. I would really like to see these assets get under control, and further research for me would involve understanding their acquisition strategy, because when you're making acquisitions each and every year, that really drives what your returns are going to look like and how you need to make adjustments to these financial statements. So for me, I'd put it on a watch list, but wouldn't buy it at this time because the price is just a little too high. If you enjoyed this video, please hit that like button. If you're enjoying the S&P 500 series and you want to see myself work through every company in the S&P 500, please hit that subscribe button and ring the bell so you can get notifications as I upload new videos in this series. Thank you for listening, and until next time, stop paying fees, start building wealth.